When it comes to investing in individual stocks, do you feel analysis paralysis? Like there's way too many companies out there for you to even begin looking into one of them. In this video, I'm going through the whole process step by step, starting with there's thousands of companies, I don't know where to begin, to I'm investing in this company because it's undervalued. One of the best places to start, just to get the ideas flowing, is with the simple stock screener. And it's great, but a lot of people don't know how to use them properly. For me, I'm going after value stocks. So I've got a few key indicators that I am filtering companies for that make a huge difference. So first of all, market cap. I want a company that's over 10 billion. I like a company that's relatively large because that means that it's, generally speaking, more mature, more stable, a little bit more safe, reliable, predictable. Those are all things that I want in a value company, because I don't know if it's a value company if I can't predict its future cash flow. So it's got to be somewhat predictable. Speaking of cash flows, the next indicator is price to free cash flow ratio. I like this more than price to earnings ratio, because in my mind, free cash flow is just a more direct way of honing in on the amount of money that a company creates or generates every year that gets returned to shareholders, to me. How do they spend free cash flow? It could be paying off debt, it could be a dividend, it could be share buybacks, or expanding the business in some way. So free cash flow, really good. I want them to be relatively low in price compared to their free cash flow. So I set that ratio to be under 20. And then next, the future free cash flow has to be good, because the markets are forward-looking. A company is going to be priced higher if the market projects that their revenues and their free cash flows are going to grow more in the future. So I also want to see some revenue growth. I've just got it in there as over 5%. Those are the only three indicators I'm looking at right now. And as I'm scrolling through this list, I'm already seeing a bunch of companies that I've already invested in that I really, really like. For instance, American Express, I've already invested in. Adobe, solid company. HCA, healthcare. PayPal, all of these are already on my list. And another company that jumps out at me that I recognize that I've had positive experiences with is Airbnb. And that is the second step that I love to use. Is I like to invest in companies that I'm familiar with. I know their business model, I can understand them, and I've had good experiences with them. So with that, I'm taking Airbnb to the next step. And before I leave this page, I should also note that Airbnb has a 11% revenue growth over the next 5 years projected. They have a gross margin of 83%, which is huge. On this list, it is the second highest right here, only behind bookingholdings.com. And their operating margin is also really good at 22%. So qualitatively, looking at my screening filters, they look really strong. But I have another method that I use to give qualitative analysis on my automated spreadsheet. I type in Airbnb at the top, and on this tab right here, I use Warren Buffett's red flags and green flags. It's all automatically calculated. If a cell is highlighted green, it's a green flag. And what that means to Warren Buffett is that it's very strong evidence that a company has a durable competitive advantage. If it's highlighted red, then he tends to stay away from companies more that have a lot of red flags. What a red flag really means is that you need to look deeper into that red flag to see if there's a good reason for it. I don't have time to look into a company that has tons and tons of red flags, so I will just move on if a company has too many. It could be a good company to invest in, but it's just not the one that I'm going to be spending time and energy looking into. So with Airbnb, there are 0 red flags. I do see some cells that are highlighted red, but that is back in 2021 and 2020. They have really high gross margins. Their percentage of selling, general, and administrative expenses is a low percentage of their gross income. Warren Buffett likes it to be under 30%. If it's over 80%, then it's a red flag. So Airbnb is at 47%. Their R&D is a low percentage of their gross. This is one that I really like to see, especially in today's market environment where we could be going into a recession. I like to see that their interest expense is very low compared to their operating income. And Airbnb has 0 interest expense, so they're not having any debt payments. High debt payments is one of the biggest risks to a company going out of business. They take a hit to their revenue. They have to pull out more debt, which means they have a higher and a higher interest expense, and it just snowballs into a bad situation. So I like that we're avoiding high interest payments, really high profit margins. With these graphs, we can see the earnings per share and the profit per year trending upward. Their long-term debt divided by their profit is very low. This means they could pay off all their long-term debt in 1 year if they had to, actually 3/4 of a year. Their inventory profit, well, they don't have inventory, so this graph I can't really use. Their retained earnings is currently negative. So what that means is they've losing money in the past. So they've just recently become profitable, but the negative number is decreasing. So their earnings are starting to eat away at their negative retained earnings. So that's good. It would be better if their retained earnings was already positive, but this graph also looks really good. Their cash is increasing while their debt is decreasing, and their goodwill is constantly increasing. Capital expenditures is low, depreciation is low, and their adjusted current ratio is above 1. So everything here looks really good. Their shares outstanding recently has been dropping, so they've been buying back shares over the last 3 years. They issued a lot of shares in 2020 and 2021, which I would expect to see because those are the years before they became profitable. Qualitatively, Airbnb looks great. Now let's move on to the quantitative analysis. I like to use a discounted future free cash flow calculation for their intrinsic value. So the first step is I want to get an idea for what does their future free cash flow look like. And on Airbnb's stockanalysis.com page, I can see over the last 5 years, first of all, that their stock price has been relatively flat. Meanwhile, when I go to their financials, their revenue has doubled since 2021. To me, this is a really strong sign that maybe their current share price isn't pricing in all of their growth, but let's not get sidetracked. Let's go to the forecast section. This is where I can see their future revenue projections. The highest analysts are saying 20% basically revenue growth over the next 5 years, which is huge revenue growth. The average analysts are saying low double-digit growth. And then the lowest worst case scenario analysts are still projecting basically flat revenue. I'm going to take these estimates and plug them into my automated spreadsheet calculator. That gives me 3 projections for their intrinsic value. The lowest analysts giving me a 5% undervalued based on those future revenue projections and based on their past free cash flow margin. So what I do is I take future revenue, I use their historic free cash flow margin to get an idea of how much of that revenue they're going to turn into future free cash flow. And I want to actually expand a little bit on the past free cash flow margin. So this is the average. However, right here, I'm adjusting their free cash flow margin up by 4%. Why am I doing that? So first, let's look at what their free cash flow margin is year over year in their financials tab on stock analysis. So if I go to the cash flow section, scroll all the way down, I can see free cash flow margin. Over the last 12 months, it's been 39. In fiscal year 2024, it was 40, 39, 40, 38. So in my mind, even though I'm taking into account the last 5 years where they had negative free cash flow margin, this is where their free cash flow margin is sitting. It's going to be about 39%. So you would think that I would use, let's say 39, but if I go back to my tab, the average is 27. I'm not adding 13% to it. I'm only adding 4%. So I'm giving them credit for 31% free cash flow margin. Why 31%? It's because I take some credit away from Airbnb because of their stock-based compensation. When I go to the cash flow calculation page right here, 1.47 billion they paid their employees in stock. So this is an expense for them. This expense was taken out of their net income, but it wasn't a cash expense. So all of that cash gets added back into their free cash flow. They're getting credit for all this cash that they didn't pay out. However, if I look at how they're spending their free cash flow, right here, they're repurchasing 4.4 billion in common stock. So they're giving their employees 1.47 billion in stock, and then they're buying that stock back. This is really just paying their employees with extra steps. So I am taking credit for this 1.4 billion, and that is where this 31% free cash flow margin comes from. So right here, this is where I am taking away credit and adding credit back in. I'm giving them a little bit of credit for R&D because they're coming out with some new products. So that's 10% of R&D I'm giving them credit for. And then 90% of their stock-based compensation I am taking away. With that in mind, the new average for 2024 is 31%. For 2023, it's 31%. For 2022, it's 33%. And 2021, 27%. So based on these numbers, that is where I'm coming up with my personal future free cash flow margin of 31%. So 31% plus the analyst projections. The lowest gives me a current share price of 133, which is 5% undervalued. Plus I have a discount rate on those future free cash flows of 7.5%. So with that in mind, Airbnb looks incredibly undervalued. The upside, if the highest analysts are correct, then that's a fair share price of 272. That's over 100% upside. Their past revenue growth has been 27%. There's a chance that they could continue growing their free cash flow by 20% or growing their revenue by 20% every year, according to the highest analyst projections. So this high upside is within the realm of possibility. Now, if I use their past revenue projections, then the upside becomes 170% if they're able to grow at 27% revenue every year, which would be huge. My projection right here is based on these figures. So I have put in a 3% revenue growth over years 1 through 5, 3% for years 6 through 10, and then 3% for perpetual. So I'm assuming that they're just going to grow with inflation. Based on that assumption, I'm seeing a fair share price today of 138. That's a 9% upside. So Airbnb looks really good to me, but I also want to check, what does the company say about its future outlook? The best place to find the most recent information on a company's own outlook is on their investor relations. I go to their press release for the most recent quarter, which is right here. Their outlook for Q2 in 2025 is they are expecting 9 to 11% year over year growth for their revenue. That looks really strong. For their entire fiscal year of 2025, they do not give a revenue projection, but they do give an adjusted EBITDA margin. So EBITDA is earnings before interest, taxes, depreciation, and amortization. So they are saying this EBITDA margin, this is a measure of profitability. They're expecting 34.5% for fiscal year 2025. If we want to compare that to Q1 in 2025, their adjusted EBITDA margin was 18%. So they're expecting their profitability to improve throughout the year. If I want to compare that to their adjusted EBITDA in fiscal year 2024, they were at 36%. So their profitability is just slightly lower, pretty much in line. For Q4 2024, their adjusted EBITDA was 31%. So they're expecting a really profitable rest of the year. This information is relatively recent. This was posted on May 1st of 2025. So this is taking into account a lot of the market uncertainty, tariff uncertainty, and they're still confident in their fiscal year 2025 profitability. This guidance was reaffirmed from their last quarter, so they haven't changed anything. In terms of future projections, Airbnb is looking really strong. In terms of their discounted future free cash flow valuation, they're looking undervalued with a huge upside potential. And finally, I also want to look at how are they spending their free cash flow margin or their free cash flow from previous years. So if I go to fiscal year 2024, the way free cash flow is calculated is they take their operating cash flow and they subtract capital expenditures. They don't have any capital expenditures. That's good. They are spending $541 million investing in securities. So they've got some investments. They are repurchasing $4 billion in common stock. They do not have any debt. So almost all of this, or pretty much all of this, $4.5 billion, $500 million goes into investing in securities. $4 billion goes into repurchasing common stock. This is a great way for them to be spending their free cash flow, assuming they are undervalued, because they're able to take all of this cash and they're able to put it back into the company by buying shares that are undervalued. So if the market understands the value of Airbnb and the share price goes up, they're going to get even more benefit from all of this money spent repurchasing company stock. $4 billion in fiscal year 2024, $3.5 in 2023. 2.1 in 2022 and 1.5 in 2020. So lots of company stock they've bought back over the years. They continue to have strong performance. We're going to see big dividends on this stock repurchase program. This is my public YouTube portfolio series. This week, I'm investing in Airbnb. The current share price is $125.50. I invest in a different company every single week, about $100. You can see my portfolio where I keep up with that right here. So we've got currently $2,550 invested. We are up 11.6%. That is the money weighted rate of return. The total return is about 5%, but the money weighted is probably a little more accurate because it takes into account the time of the investment. So investments that I made last week are not going to go into that equation very much because this is an annual return calculation. So investments that I made longer ago are going to weight heavier on this calculation. But if we look at my current holdings, the majority of my investments are green. The three that are in the red are Simply Good Foods, Akame Technologies, and Google. All three of these I did double down on recently because I have high conviction that all three of these are an even better price than when I initially bought them. So even though they're down, I put a little bit more into them. Now for this video, I used a stock screener to find value companies. However, there are other methods that you can use to find value companies, specifically ones that leverage AI, which are incredibly interesting. You can see that in this video right here. Cheers. Or you can just check out this cat.